Hi everybody, welcome back to another video. Apologies for the long wait as I was shifting to my own personal house and I'm also arranging for my own marriage as well. So now I'm more or less settled down, so I'm having much more time now in order to do the recordings. I have also given some thoughts into how I should go on recording for the upcoming earnings. So in the future videos, I'll only emphasize more on the important points of the earnings that we can receive from the quarterly earnings. This will allow me to combine more REITs earnings into one video, and of course saving your time when it comes to viewing it. Without much further ado, let us not waste our time and go to the first analysis, and that will be AA REIT. So let us get right into the Q1 of full year 2024 based on the REITs report. And as you can see from the key highlights, there are green valuations everywhere. From revenue, which is positive of 4.5% year over year, net property income of positive 4.2%, distributable income even higher with a raise of 5.1% year over year. And of course, this resulted in a higher DPU. So in this kind of high raising interest rate environment, it's very impressive for REITs to continue to increase their DPU. Next, their occupancy also went up slightly from 97.9% last year to 98.1%. Rental reversion increased by a huge value of 38%, which we will look into later. However, their retention rate was only at a 68%. So this is a slight concern, but it's not big as long as they have a very high occupancy rate. Gearing ratio is at a 32.9% because due to their recent issuing, which allows their gearing ratio to be at a very healthy level and make possible for future acquisitions. Next, their borrowing cost is fixed at 87%. However, the only bad thing that I can take out of these key highlights is that their Australia distributable income is only hedged with 69%. So this meant that there's a 31% that is floating. And if you are following currency closely, Australia dollars have weakened a lot constantly through Singapore dollar. So this factor here might be one of the decreasing factor that will affect the distributable or the performance of AA REIT. So if we look at their balance sheet, their gross revenue went up to 43.1 million, whereas their net property income was 32.3 million. So this equates to about a 74.9% margin after deducting property expenses for their net property income. Their distributable income is at 17.1 million. So how this is the remaining amount is equates after all the other miscellaneous expenses, and also especially the biggest expense will be the interest payments for their debts. So with the dividend at $23.10 per lot per quarter, we can equate or analyze it assuming that it's constant throughout the 4 quarters. It will give a total of $92.40. With the share price at the current rate of about $1.20, it will give a yield of about 7.51%. This is quite decent compared to other REITs which are only giving at 5+%. And you also have to take note that it's much higher as compared to banks and bonds as well. But when it comes to investing, it's also a risk to take. That's why the yield is much higher. So looking at their gearing ratios or their debts profile, you can see that their leverage ratio is at a healthy level of 32.9%, whereas the government limit is at 50%. Cost of debt is at 3.9% average, whereas their interest coverage ratio is at 3.6 times. However, what I do not like about their debt profile is that their adjusted interest coverage ratio is at a very risky level of 2.2 times. So how this value comes about is because if you can see the notes, the adjusted interest coverage ratio includes the amount reserved for distribution to their perpetual securities holder. So how this comes about is because AA REIT has issued a lot of perpetual securities to this group of people. Because of that, they also have to reserve a pile of distribution that will be required to be distributed to them. If we look at their debt maturity profile, good thing is that they have no refinancing required for the full year of their financial year of 2024. And how we calculate is by looking at the current month, which is July. So because of this, their full year of 2025 only starts next year, July. So in my opinion, the Fed would definitely start cutting rates next year onwards. So because of that, AA REIT might actually benefit from refinancing their new loans the next year. So what I would like to emphasize on would be their strong leasing outcomes due to their high positive rental reversion. If you have followed my previous video on AA REIT analysis, I've mentioned that for logistic and warehouse, it will definitely perform well. It's only how well it will perform. As you can see for this quarter, it has performed at a good level of 16.5% reversion. This means that customers are renewing their leases at a much higher rental of 16.5% in average. Industrial-wise, it came in at 3.4%, which is still quite decent, while Business Park has a negative 2.2%. For Business Park, this is expected because offices in the office environment currently are not doing well as well. And as you can see, for the passing rentals and the market rents, AA REIT is still at a lower level compared to the market rent of $1.50 to $1.90. So this brings about still a lot of potential for subsequent new positive rental reversion. As you can see, for the financial year of 2024, they still have 13.3% of logistics required to be renewed. So expect this to continue to perform well for AA REIT. So what are the risks and rewards for AA REIT? The first risk would be the decreasing retention rate. This shows that AA REIT might not have a good retention with their customers, but this, in my opinion, is a small risk. The next risk, which is much bigger that I feel, is because of the constant decrease or the weakening of the Australian dollar. This would definitely have a larger impact on their earnings. Lastly, lower rental reversion as expected, which in my opinion is a low probability with considering the fact that the logistics are still in demand and will do well. So for the rewards, they have a very low gearing ratio, which gives them more opportunity for asset acquisitions or asset improvements. Moreover, if the logistic rental renewals continue to perform well, this would definitely lead to higher dividends in the upcoming quarters. So with this, we'll look into how AA REIT will perform in the upcoming quarters. The next REIT that I would like to touch on will be Mapletree Industrial Trust. So looking at their key highlights, their net property income increased by 0.7% year over year to 130.8 million. However, their DPU decreased 2.9% year over year. This was previously due to higher borrowing costs. However, if we look at quarter over quarter, it increased by 1.8%. And they have mentioned that it was due to lower operating expenses because they have found ways to adapt or pass on the utility costs or the expenses to customers, and also a slightly lower borrowing cost as they hedge. However, this DPU might have to be take note because their third major tenant, which recently collapsed, which is Cyteria Technologies, might affect them in the short term with regards to the distribution. However, they have also had an exciting acquisition, which is the newly built data center in Japan for 52 billion on 25th May of 2023. Personally, for me, data centers is the thing to go to, and Mapletree Industrial Trust is definitely going in the right direction. However, the acquisition will only be expected to complete by Q3 of 2024. So the next few quarters might not be able to see its contribution and might have a lower DPU due to different reasons, which I will look into later. So if we look at their balance sheet, the year-over-year sheet, it does not look very good because you can see that the borrowing cost went up by 32.5%. So this is expected and common for all REITs because of higher interest rate. And you can see because of this, it has pulled down all the values where the property before income tax dropped by 8.8%, leading to distributable incomes dropping by 2.5%, and lastly, DPU dropping by 2.9%. However, if we look at the quarter-over-quarter sheet, it looks much greener because you can see the borrowing cost actually decreased by 5%. This was because of different management of the debts, and you can see that the management are actually repaying debts as well, leading to a lower interest on debts. Their property expenses also dropped by 5.7%. This is also partially also because of the management penning or pushing on the expenses to some customers. This has allowed the DPU over quarter to increase by 3.1% and distributor per unit to increase by 1.8%. In the short term, why I say that the next quarter dividend might drop is because if you see the text below, they have actually had a net divestment gain and tax exempted income included in the DPU for the previous few quarters, and this actually amounts to about a 4.16 million of distributable income. So this actually meant that the next quarter, unless they are able to increase their revenue or income to cover this difference in the extra income, this might actually lead to a decrease in their DPU in the short term. For their debts or their leverage profile is at a healthy level of 38.2% with the average debt at 3.7 years. Moreover, with a Fitch rating of BBB+, this actually gives a boost for Mapletree Industrial Trust when it comes to loaning money from banks. And with their recent private placement oversubscribed at 4.5 times, this actually shows that institutional investors are still confident in Mapletree Industrial Trust. So this is also another pointer to take note of. And when it comes to the debt maturity profile, similar to AA REIT, they only have 14% of their loan required to be renewed at the second half of next year. And in my opinion, I feel that in the second half of refinancing next year would be a good time as interest rate will be dropping or going in the downward trend. And their debts have a 78% fixed rate with an average cost of debt of 3.5%, which if you notice is much lower than AA REIT, which was at 3.9%. So for MIT, because they are a more stable REIT, therefore they are able to get loans at a lower cost. And because of that, they also have a higher interest coverage ratio of 4.9 times and the adjusted interest coverage ratio of 4.4 times. So if you look at their occupancy for their Singapore portfolio, although the occupancy is dropping constantly since Q3 of last year, their rental rate has actually slightly go up, which is a good thing because this actually shows at least there's a leeway for them to play around when it comes to increasing their occupancy. So what are the risks and rewards for Mapletree Industrial Trust? So the first risk will obviously be the drop in the DPU due to the extra distribution has finished and they are unable to cover the artificially pump up of 4.16 million. Secondly, due to the loss of income from their third major tenant, which is the Cyteria Technologies, as we have not seen the impact due to the bankruptcy filing. So what is the good thing about MIT is that firstly, the private placement came in at oversubscribed of 4.5 times, which actually shows the confidence from the institutional investors. Secondly, not much debt is required to be renewed for until the second half of 2024. So expect their cost of borrowings to continue to go down. Lastly, if the Japan data centers do well from Q3 onwards, they would definitely increase their DPU in the long term. If you like my content so far, please hit the like, subscribe to support the channel and to spread financial knowledge to everyone else. Now let us go on to the last analysis, which is not a REIT but similar to a REIT which gives dividend and is a business trust, and that will be Keppel Infrastructure Trust. For those who are new to Keppel Infrastructure Trust, they are a business trust that holds different kinds of assets which are important for daily usage, such as utility, petrols, and the upcoming renewable energies. So let us go straight to analyzing their distributable income for the quarter. At the first glance for this quarter, they did not actually perform as well as expected, because the overall distributable income came in at 59 million, whereas for the previous quarter it came in at 73.9 million. So the drop happened from various assets, such as from City Gas, which had a slight drop of 1 million, the Berlin offshore wind farm dropping from 19.46 million to 12.94 million. Moreover, their EMK also came in at a negative 1.2 million. So we have to look more into what is the reason. For Exxon, it also dropped from 21 million to 16 million. And for Philippine Coastal, which is their oil storage assets, also dropped by slightly from 2.4 million to 2 million. And lastly, their trust expense also went up by 4 million, resulting in a drop from 73.9 million to 59 million. However, there are also some good showings, with Aramco gas pipeline increasing distributable income from 10 million to 19 million. So let us also look into how their new assets actually perform based on the recent results. For Aramco pipeline, obviously is performed very well, with first half of year 2023 coming in at 30 million, and with the initial investment of 340 million, their ROI would be annualized to about 18%. Whereas for their European onshore wind farm, it came in at 2.5 million for the first half and annualized to be only around 5%. For their Berlin wind farm, it came in at 32.3 million from their first half, resulting in a very good ROI of 17.7%. Lastly, EMK came in at a distributable income of 3,100. However, do take note that this ROI is not accurate because it only is based on the 2 quarters results. And as you can see from the recent quarter, the Berlin and the EMK actually did poorer as compared to Q1. So we will have to need more quarter results in order to see. For KIT, one of the most important parameters throughout the years is their dividend payout ratio. So let us take a look at how much was being distributed. So based on first half of year 2023, their announcement of dividend would sum up to be about 108.5 million. And the good thing is that for their distributable income available, their income adds up to be about 132.9 million. So this is still a very healthy level, as the dividend payout ratio is equal to about 81.6%. So in general, what is the good and the bad thing about Keppel Infrastructure Trust? As you know, Keppel Infrastructure Trust has a lot of Singapore assets, especially the water utilities. And because of that, one of the biggest risks is due to the loss of distributable income from the concession ending of various water assets. They have 2 wastewater plants that would be expiring in the next 2 years. And based on their conversation, the probability of the extension by the government might be low. So therefore, it's very hard to say what will happen to these 2 assets. Similarly to the second risk, Keppel Infrastructure Trust runs most of its assets based on concession. So therefore, if you look at their balance sheet, the rate of depreciation is always at a very fast high value, because most of their assets runs on leases. And as the leases runs down, their assets decreases in asset values. The last risk, which is the biggest risk, would be that their new assets do not perform as well as expected. Definitely, there are also good pointers with regards to Keppel Infrastructure Trust. Firstly, would be the new assets providing a good ROI in return. For example, currently, Aramco pipeline and the Berlin offshore wind farm is producing quite a good ROI. But we will have to definitely see more quarters in order to see the actual performance. For the second positive pointer for Keppel Infrastructure Trust is that they do not have debts renewed until second half of 2024, similar to Mapletree Industrial Trust. So this ensures that their cost of debt do not skyrocket up due to having to be forced to refinance during this period of higher interest rate. Lastly, if the oil prices goes up or remains high, Keppel Infrastructure Trust definitely benefits from it, be it the renewable energy or the Aramco pipeline asset itself. So I hope this 3 quick analysis of the recent results brings about better light or clarity with regards to either of these shares. If you enjoyed the content, it will be greatly appreciated for you to hit the like, subscribe, and if you would like to support the channel, you could also look at my Twitter or any affiliate links down below. Thank you so much for watching, and I'll see you in the next video.